Can SCHD and JEPI really pay you $5,000 a month? That's the dream, right? Passive income rolling in every month while you sleep, just from 2 dividend ETFs. But let's get real for a moment. This isn't about overnight success, viral TikToks, or chasing meme stocks. This is about a practical, data-driven strategy that combines 2 of the most powerful income-focused ETFs available today. SCHD, known for its rock-solid dividend growth, and JEPI, famous for its juicy monthly payouts thanks to its covered call strategy. In this video, we're going to explore whether this combo can actually produce $5,000 a month in income, and more importantly, how an average investor can realistically get there. We'll cover the numbers, the tax realities, the risks, and even some alternative ETF options. Because this isn't just about hitting a number, it's about building a strategy that works for your goals, your timeline, and your financial future. Let's start by understanding exactly what these 2 ETFs are and why so many dividend investors are excited about them. First, SCHD, the Schwab US Dividend Equity ETF, is one of the most trusted dividend growth ETFs in the market. It holds around 100 high-quality US companies with a strong track record of paying and growing dividends. Think Coca-Cola, Pepsi, Verizon, and Merck, solid names with stable cash flow. SCHD pays a quarterly dividend, typically offering a yield between 3.5% and 4%, and it focuses on sustainable payouts with a strict screening methodology. Now, on the other hand, we have JEPI, the JP Morgan Equity Premium Income ETF. This one is a different beast. JEPI not only invests in large-cap US stocks, but also uses a covered call option strategy to generate consistent monthly income. This approach often pushes JEPI's yield up into the 7% to 10% range, though the trade-off is slightly lower capital appreciation. Together, SCHD gives you dividend growth and long-term stability, while JEPI boosts your monthly cash flow. It's a powerful combo, one focused on sustainability, the other on yield. So, how much do you really need to invest in SCHD and JEPI to start earning $5,000 a month? Let's get into the numbers and see how this plays out. We'll begin with a realistic assumption. If you combine JEPI's high monthly yield, often hovering between 9% and 11%, with SCHD's more conservative 3.5% to 4.5% yield, your blended annual yield would sit around 7%. That means for every $1,000 invested, you'd expect to earn about $70 in dividends annually. Now, to earn $5,000 per month or $60,000 per year at a 7% yield, you'd need to invest roughly $857,000. Yes, it's a big number, but here's the key. That figure isn't meant to discourage you. It's meant to anchor your long-term vision. Because dividend investing is a marathon, not a sprint. And you don't have to hit $857K tomorrow. Let's build a few stepping stones. At $100,000 invested, you'd earn around $7,000 per year, or about $583 per month. That's a car payment, or half the rent in many cities, just from holding 2 ETFs. At $250,000 invested, you're looking at a $1,458 month, which covers groceries, bills, or a mortgage. At $500,000, you're halfway to the target, generating $2,916 month, enough to fund full-time living in many regions, especially if you live frugally or geo-arbitrage abroad. These milestones matter because each level you unlock replaces more of your expenses with true passive income. The best part? You don't need to contribute massive lump sums. If you start with $5,000 and invest $1,000 per month for 20 years, with reinvested dividends and a modest 8% total return, you'll pass the $800,000 mark. And that's without needing to get rich in the traditional sense. It's math, it's consistency. It's compound growth in action. One pro tip. If you reinvest your dividends instead of taking the cash early on, your investment snowballs faster. That's called dividend reinvestment, or DRIP. And it can accelerate your path to the 5K month goal over the years. But of course, the moment you need the income, you can pause the reinvestment and have the cash flow deposited directly into your account. The takeaway? $5,000 a month is absolutely possible. But don't treat it like a lottery jackpot. Treat it like a financial finish line you're jogging toward. One contribution, one reinvested dividend, one patient year at a time. Now let's dig into a part of dividend investing that most videos either skip or oversimplify: taxes. Because earning $5,000 a month in dividend income sounds incredible, until you realize that the government wants a cut too. And the size of that cut depends entirely on how your dividends are classified, where you hold your investments, and how much income you earn in total. Let's start with SCHD, the Schwab U.S. Dividend Equity ETF. This ETF pays out primarily qualified dividends. These are dividends paid by U.S. companies that meet IRS criteria, and they're usually taxed at the more favorable long-term capital gains rate. That means if your total taxable income falls under certain thresholds, you could pay as little as 0%, or more commonly 15%, on those earnings instead of your regular income tax rate. This is one of the key reasons SCHD is so tax efficient. It rewards long-term holders not just with dividend growth, but also with lower taxes on that income. Now enter JEPI, the JP Morgan Equity Premium Income ETF. JEPI pays monthly dividends, and its yield is high, sometimes over 10%. But here's the catch. A significant portion of JEPI's income is generated by a covered call strategy, basically selling option contracts to generate extra cash. Because this income doesn't come from stock dividends, a lot of JEPI's distributions are considered non-qualified dividends or even short-term capital gains. These are taxed at your ordinary income tax rate, which could be as high as 24% to 37%, depending on your income level. So if you're making a decent salary and holding JEPI in a taxable brokerage account, your effective yield, after taxes, could be a lot lower than you think. So what's the smart move? One word: placement. If you're still building your portfolio and don't need immediate income, consider holding JEPI and SCHD in tax-advantaged accounts. A Roth IRA is ideal because all your dividend income grows tax-free, and qualified withdrawals in retirement are also tax-free. Even a traditional IRA or 401k offers tax-deferred growth, meaning you don't pay taxes until you withdraw the funds later in life, when you might be in a lower tax bracket. For investors who already have large taxable accounts or are closer to retirement, it's worth talking to a tax advisor about asset location. Putting high-yield, tax-inefficient ETFs like JEPI in retirement accounts, and keeping more tax-efficient options like SCHD in your taxable account. And one more tip: keep an eye on the 1099 DIV tax form you'll get each year. It will break down how much of your ETF income is qualified, non-qualified, or classified as capital gains. This helps you avoid surprises when filing your return and gives you a clearer view of your actual after-tax income. The key takeaway is this: it's not just about how much you earn, it's about how much you keep. Two investors can earn the same $5,000 a month in dividends, but the one with better tax planning walks away with more money in their pocket. And that's what smart investing is really about. Now let's talk about risk. Because while SCHD and JEPI are powerful income-generating tools, no investment is without downside, and understanding the risks is what separates confident investors from reactive ones. Let's start with SCHD. This ETF is built on high-quality, dividend-paying U.S. companies, and it follows a rules-based methodology that screens for profitability, dividend consistency, and financial strength. Sounds solid, right? And it is. But here's the catch. SCHD is still 100% equities. That means it's tied to the stock market. If even great companies like Pepsi, Merck, and Coca-Cola can see their stock prices, and temporarily their dividends fall. SCHD also pays quarterly, so if you're relying on it for cash flow, your income will only come in 4 times a year. Not a problem if you're budgeting, but something to plan for. Now, JEPI is a different story. It offers monthly dividends and high yields, which is why it's attractive to income-focused investors. But JEPI uses a covered call strategy. Essentially, it sells options on its stock holdings to generate income. That strategy can limit upside potential in bull markets, meaning your portfolio may not grow as much when the broader market rallies. It's great for smoothing returns during flat or choppy markets, but if the S&P 500 takes off, JEPI will likely underperform. There's also a risk tied to the structure of those option contracts. If volatility drops or the options generate less income, JEPI's yield can fall too. So while that 10% yield might look stable, it isn't guaranteed, and it can be affected by market conditions. Another big risk that applies to both ETFs is what I call the illusion of stability. Just because these ETFs are built on blue-chip companies or premium strategies doesn't mean they're invincible. Dividends can be cut, companies can get downgraded, market sentiment can shift, and suppose you're putting a large portion of your portfolio into just SCHD and JEPI without diversifying into other sectors, international equities, or fixed income. In that case, you're more exposed than you might think. That's why the key to managing risk isn't just choosing solid ETFs, it's about having a plan. Diversify across asset classes, know your time horizon, reinvest when you're in accumulation mode, and if you're withdrawing for income, maintain an emergency cash buffer so you're not forced to sell in a downturn. SCHD and JEPI are excellent tools, but they're just that, tools. They're not foolproof, and they should be part of a broader, well-thought-out financial strategy. While SCHD and JEPI make a strong case as a dividend powerhouse duo, no smart investor puts all their eggs in two baskets. Diversifying beyond just these two can reduce risk, increase income stability, and expose you to opportunities that SCHD and JEPI might miss. So let's talk about some complementary and alternative ETFs you can add to your dividend portfolio to round it out for better resilience and growth. First up, consider VYM, Vanguard High Dividend Yield ETF. It tracks the FTSE High Dividend Yield Index, which focuses on large U.S. companies paying higher than average dividends. VYM holds more than 400 stocks, making it more diversified than SCHD, and while its yield is slightly lower, around 3%, it spreads risk broadly across sectors. It's a great addition if you want more cushion during downturns. Next, DGRO, iShares Core Dividend Growth ETF. DGRO emphasizes companies that not only pay dividends, but also consistently grow them. This makes it ideal for long-term investors who want a rising income stream over the years. DGRO complements SCHD well because it uses a different selection methodology and often includes companies that SCHD might exclude. Another solid option is DHS, Wisdom Tree High Dividend Fund. This ETF is a bit more aggressive, focusing on the highest yielding stocks in the market, but with a quality filter. It offers a higher yield, typically in the 4%-5% range, though it can be more volatile. It's useful if you're building a dividend ladder or want to tilt toward income now versus growth later. And don't forget about international diversification. IDV, iShares. International Select Dividend ETF provides exposure to high-yield dividend stocks outside the U.S. This gives you global reach and reduces dependence on the U.S. economy. International markets may move differently from domestic ones, so adding global dividends can help balance portfolio performance when U.S. equities lag. Lastly, if you want even more consistent cash flow, consider REIT ETFs like VNQ, Vanguard Real Estate ETF. REITs are required to pay out 90% of their income as dividends, making them excellent for yield-focused investors. While VNQ doesn't perfectly align with JEPI or SCHD, it provides uncorrelated income from real estate holdings, which is a unique and valuable addition to any income strategy. In short, SCHD and JEPI can be your core, but adding complementary ETFs like VYM, DGRO, IDV, or VNQ enhances your income stability, sector diversification, and global exposure. A robust dividend strategy isn't about chasing the highest yield. It's about building a system that works through all market conditions. Now that you've got the strategy and the tools, let's talk about something that could make or break your success. Expectations. Because one of the biggest mistakes new investors make is underestimating how long it takes to reach meaningful dividend income and overestimating how much they'll earn right away. Yes, $5,000 a month in passive income sounds amazing, but getting there takes time, consistency, and patience. Unless you're starting with hundreds of thousands of dollars, this is a journey measured in years, not months, and that's perfectly okay. You don't need to hit the $857,000 investment mark overnight. What matters is creating a habit, automating your investments, reinvesting your dividends, and treating this like a long-term wealth-building plan, not a shortcut. Let's say you start with $5,000 and invest just $500 a month into a mix of SCHD and JEPI. Assuming a blended yield of 7% and a conservative total return of 8% annually, you could be generating $10,000 to $15,000 a year in dividends by your 10th year. That might not be full financial freedom, but it's a serious chunk of income that grows year after year. And if you keep going, hitting $2,000, $3,000, and eventually $5,000 per month becomes realistic. Not through luck, but through deliberate, compounding action. What's more, life will happen along the way. Markets will crash. Dividends might get reduced. Your income might change. The important thing is not to panic, because long-term investors understand that temporary dips are part of the process. If you zoom out, the trend is always upward. And that's what makes this strategy powerful. It's not about timing the market, it's about time in the market. So be realistic. Start where you are. Set small goals, 100-month, then 500-month. Celebrate those wins, because each one means you're closer to building true financial independence, powered not by luck or hype, but by math, discipline, and time. Before we wrap up, let's talk about something that ties this entire strategy together: diversification. Because while SCHD and JEPI can be powerful income engines, no serious investor should rely on just 2 ETFs to fund their entire financial future. True diversification is about spreading your risk across different asset classes, sectors, geographies, and even income types, so no single downturn or market shock can derail your entire plan. Here's how that looks in practice. If your core holdings are SCHD and JEPI, great. That covers U.S. large-cap dividend stocks and a high-yield income-generating strategy with JEPI's covered calls. But you're still heavily concentrated in U.S. equities. To reduce that concentration risk, you can add a global dividend ETF like IDV or VYMI, which provides exposure to non-U.S. companies that pay strong dividends. This not only adds currency and geographic diversification, but also gives you access to different economic cycles that may not correlate with the U.S. market. Next, consider including some red exposure through ETFs like VNQ. Real estate has historically moved differently from stocks, and REITs offer steady, inflation-resistant income. Their dividends tend to be higher, and they're required to distribute most of their taxable income to shareholders, making them a solid complement to traditional dividend ETFs. Then there's fixed income. Even if you're not ready to invest heavily in bonds, a small position in a bond ETF like BND, Vanguard Total Bond Market ETF, or a short-duration bond ETF can add stability during stock market volatility. As interest rates fluctuate, these assets can either provide a floor or a cushion for your income-focused portfolio. Lastly, don't ignore cash or high-yield savings as part of your income strategy. Keeping 3 to 6 months of expenses in a high-yield savings account acts as your buffer. It protects you from having to sell investments during a market dip and ensures you can keep your ETF income compounding. The big picture? SCHD and JEPI can absolutely be the foundation of a strong dividend strategy. But your portfolio should be balanced, flexible, and built for all seasons. Diversification doesn't dilute your strategy, it protects it. And in the long run, that protection is what allows your income and your peace of mind to grow uninterrupted. So, can SCHD and JEPI get you to $5,000 a month in passive income? Absolutely, but not overnight. It's going to take patience, a plan, and consistent investing. But what we've seen today is that these 2 ETFs, when combined strategically, can create a foundation for real, inflation-beating income. SCHD offers you stability and long-term dividend growth. JEPI brings in monthly cash flow and a higher yield. Together, they can help you build a portfolio that isn't just about wealth but about freedom. But remember, success here isn't just about picking the right ETFs. It's about staying in the game. Reinvest your dividends, stay diversified, think long-term. You don't need $857,000 tomorrow, but every $100 you invest today moves you closer to that financial freedom target. If this video helped you understand the strategy, please give it a thumbs up to help it reach more smart investors like you. Subscribe to the Cash Chapter for more faceless, data-backed investing strategies every week. And drop a comment below. What's your current monthly dividend income goal? Are you investing in SCHD, JEPI, or building your own ETF combo? I personally respond to every comment because I believe in growing this channel as a community. Let's build wealth together, one dividend at a time.